Well, the Fed is clearly being pulled in two different directions right now. One is that I think that the cooling, but not collapsing labor market makes it want to cut. And I think
it cooling?
I think it is cooling. It's cooling, but again, I want to emphasize not collapsing. So we are seeing a slowdown in private jobs growth. We're seeing that the jobs that are being created within the private sector are concentrated within a relatively small number of industries. And that definitely does make it a little bit worrisome that that number is about to fall a little bit more. But we're certainly not seeing anything that's sort of commensurate with a recession or anything like that in the United States. So we're above neutral, I think, the Fed is, in terms of the Fed funds rate. And given where the labor market is going, I think that all else equal, they would be cutting a little bit more than they have so far.
To what extent do you think the expectation of cuts from the Fed is what's driven equity markets higher from here?
I think that equity markets have gone higher more recently because I think the impact of Trump's tariffs have not been as severe on the economy as a whole as has been seen. So I don't think that the Fed has really been the driver of this. I mean, if you go back to April, the market was expecting there to be 4 Fed cuts by the end of the year. Now it's expecting between 1 and 2. So if anything, the sort of surprise, so to speak, in terms of what market expectations are going to be for the Fed has been fewer, not more cuts. So I think it's sort of in spite of that, actually, that markets have recovered. And it's because the economy, the real economy, has held up pretty well with respect to tariffs.
To that point around the expectation shifting from deeper cuts to more subtle cuts, this messaging was coming through from the Fed too, that, look, we might be close to neutral. How do you assess whether we're going to get to the point where we're not providing any stimulus and we're not tightening, we're just going to be at some sort of neutral level for the Federal Reserve when it comes to rates? Yeah,
I mean, it is incredibly difficult in the short run to figure out what neutral is. Even looking back, it's hard to do, so let alone in the short run. I think that with a couple exceptions, most FOMC members, and importantly Chair Powell, do seem to think that we are still a little bit in restrictive territory. And I think that that's correct. That's what our analysis would say as well. But the Fed isn't sort of slamming on the brakes anymore. It's just sort of tapping on the brakes, so to speak. So I think that when the Fed has the opportunity, when it feels that tariff-induced inflation either is in the past or if it doesn't happen at all, it's confident about that, it will be cutting a little bit more. But again, we're talking about, in aggregate through this cycle, we think maybe 3 more 25 BIP cuts is really all that's necessary.
When July 9th was on the table as the tariff deadline, the expectation seemed to be that we would start to see an uptick in inflation around September. That's when we start to see the impact of tariffs. Now that it's been pushed out to August 1st, and clearly there's scope for it to be pushed out further given the track record of President Trump, to what extent could that impact the Fed policy path from here and the overall inflation picture if we're not looking at an uptick in prices until maybe early January, given that the Christmas period is before then, so consumers might not feel it as acutely?
Yeah, I think what's going on right now, July 9th, August 1st, whatever it ends up being, is actually pretty small. I think what really matters is the tariffs that have already been put into place. We went, when Trump took office this time, from a 2% average effective tariff rate, briefly touched 30, and settled now around 18. Looks like now, on August 1st, it might go up, assuming the EU deal comes out all right, it might go up only 2 or 3 percentage points. So we're talking about a move that is really on the order of maybe 1/10 what we saw in April and preceding April. So I think really the inflation that we will or will not see over the summer is based on the actions that President Trump took in February, March, and most importantly in April, and far less on what's going on now. And I think the muted market reaction to what has been going on so far is because, yes, there's a lot of headlines coming out. There are a lot of countries being covered. But the big four are sort of the EU, Canada, Mexico, and China. And only the EU is really in discussion right now. And the expectation is that it's looking as though that deal is proceeding pretty well.
I think it's fair to say that Trump is a disruptive force when it comes to the macro. And Steve was just mentioning before about the Fed members and how vocal they've been in terms of posturing perhaps ahead of any future appointment of the next chair of the Federal Reserve. Bowman and Waller, for instance, are siding with Trump almost around the suggestions of the necessity for rate cuts. But when it comes to what we've had from the Federal Reserve so far, singing from the same hymn book, mostly in unity in terms of direction for the Fed, that seems to be breaking down slightly at this stage. What's the relevance here as we still wait for an onslaught of incoming data around the macro, while we need a Federal Reserve that is working from an independent stance to set policy that is right for the economy without some sort of political posturing around Trump? How are you thinking about these factors?
Yeah, I think so far it hasn't changed things all that much. But I do think it's important that we have the two Trump appointees on the Fed who have shown themselves to be the two most dovish members of the Fed, and frankly have certainly adjusted their position since President Trump took office, most notably with Michelle Bowman having a very sudden change just a couple of weeks ago.
Are you saying it's like having sleepers there?
I'm sorry?
It's like having sleepers. People you've appointed, you've put there, and suddenly you can activate them.
Well, I wouldn't go that far. I didn't necessarily say they're sleepers. But, you know, as Trump appoints more people, including the next chair, I think we could start to see the Fed behaving or interacting in a very different way than before. You know, in the UK, for example, no one would be shocked to see Bailey outvoted by the rest of the Bank of England. In fact, it was less than 20 years ago that Mervyn King was outvoted in a 5-4 vote. It does happen here, and it's a real vote that takes place. In the United States, it is effectively a dictatorship of the Fed chair. Very rare to have dissents, and very, very rare to have multiple dissents. I think that as the new Fed chair takes office, if that Fed chair is out of line with the majority of the FOMC, we could start to get into a situation where we have to count the votes for the first time in the United States with the Fed, where we have to really sort of consider not just what the Fed chair wants, but what the committee as a whole wants. And that would be a very different dynamic from anything we've seen. But that's still about 11 months away from happening.